This paper focuses on the causes of the financial crisis. We look at the role of executive compensation. When I use the word executive compensation, I'm referring to the compensation of the very senior CEO, CFO, and 2 or 3 other senior level executives in these banks. There are 2 narratives about executive compensation in these banks. The first narrative takes the viewpoint that these executives are hardworking, they're trying to create shareholder value, and the incentive compensation that they receive would give them the incentives to essentially maximize their shareholder value. Then there is a darker side, which is that these executives received incentive compensation that gave them some very strong incentives to engage in very high-risk investments. There is no problem in engaging in high-risk investments. In fact, the role of businesses is to engage in risky ventures, but risky ventures that create value for their shareholders. So what we have in mind with regard to these large bank executives is they were engaging in very high-risk ventures that did not create value for their shareholders. We looked at the insider trading behavior of these executives in these large banks that received the TARP funds. TARP funds were the funds that were associated with the public bailout. And we compared the insider trading behavior of these TARP banks to other banks that did not request or receive TARP funds, and compared the insider trading behavior of these 2 sets of managers. Here you have 2 sets of banks. TARP shareholders don't do very well, non-TARP shareholders do very well. How about the managers of these? The managers or the senior executives in the large banks, they did very well. Because of their insider trading, they would take a lot of money off the table every year. Now, we're not talking about like a few $100,000 or a few $1 million either. Some of the executives of the large banks were selling shares or exercising options and then selling shares to the tune of several $100 million in a year. I would like to know what kind of liquidity needs they might have had to sell so much stock. An alternative explanation is they knew they were engaged in a very high-risk set of investments, and sooner or later these risks will not pan out. On the other hand, when you look at the insider trading behavior of the banks that did not ask for, nor did they receive TARP funds, the senior executives of these banks sold a minuscule amount compared to the large banks. Not in this set of smaller non-TARP banks, we found some CEOs that held shares of an order of magnitude comparable to the shares held by the CEOs of the large TARP banks. The facts suggest that the CEOs of the large banks knew perfectly well what they were getting into. They were engaged in a very high risk but essentially value destroying set of investments, and since they knew these investments were value destroying, they would take a lot of money off the table. They would not have much to lose. What we recommend in this paper is to adopt an incentive compensation structure that will prevent this kind of incentive structure. Specifically, what we are recommending is that going forward, the incentive compensation of all senior bank executives be based strictly on restricted stock and restricted stock options. Restricted in the sense that shares cannot be sold or the options exercised for at least 2 to 4 years after their last day in office. So if they have to look at an 8-year horizon and they know that they have to hold the share for this time period, they are less likely to invest in value-destroying investments. If our recommendations were accepted by the large banks, then we think they would not get into this trouble. They would not cause such havoc in the financial markets and then in our economy. Thank you.